Hello. In this video, I will discuss how the government of a country determines the economic activity of that country. In order to measure the economic activity of a country, government uses the tool of national income accounting. So what is national income accounting? It is a comprehensive bookkeeping system employed by government to measure and track the economic activity of a country over a specified period, such as a quarter or a year. It is a bookkeeping system. It helps the government to keep record of the economic activity of its country over a specified period. Now, what is economic activity? Economic activity refers to any action that involves production, distribution, or consumption of goods and services. Economic activity refers to any activity that generates income and wealth through the production or exchange or consumption of goods and services. This system provides a structured and detailed framework for recording the value of a nation's production, consumption, and investment. This system gives a clear idea how much a country is producing goods, how much it is consuming goods, and how much money is spent as investment. Investment, for example, machinery bought by a company to produce goods, or government building highways, bridges, which helps in transport and future trade. So investment is money spent on capital which will produce more goods and services in the future. The national income accounts are composed of several key aggregates, each measuring a slightly different aspects of economic activity. The five most central aggregates are GDP, GNP, NDP, NNP, and national income. Next is gross domestic product, GDP. What is GDP? Total market value of all final goods and services produced within India's borders during a given period. In other words, GDP counts output by all producers located in India regardless of who owns them. So the important points here are total market value, all final goods and services produced within India's borders. So as different companies are producing or making their product, the market value of those products. Now, what is market value? You see, whenever you buy an item, as you can see in these pictures, there is the market price of those values. That means if you buy that product, that much money you will have to give to the shopkeeper. So this is a calculator. As you can see, the market price is 425 and in there it is written inclusive of all taxes. Again, there is a pen set where the market price is 275 inclusive of all taxes. And next there is market price. This is a packet of incense sticks. The market price written here is rupees 55 inclusive of all taxes. So this is market price. It is the price with which a customer buys the product. Next you see final goods and services. Now what is final goods? As you can see in this image, on the left side is the final good. That is, the cars are finished manufacturing. And on the right side, cars are being manufactured. So in GDP calculation, the price of the finished goods are counted. I repeat again, in GDP calculation, the market price of the final goods, that is the goods that are finished manufacturing, the final goods, the market value of the final goods are counted, not the price of the intermediate goods required to make the car. For example, in this picture, in the left side, you can see this is a car dealership where you get the final product, and on the right side, the cars are being manufactured. So, in GDP calculation, the market price of the final good is taken, not the price of the intermediate goods required to manufacture this car. For example, the cost of tires, windshield, seats, engine, labor cost, those are not included in GDP because they will be calculated separately, like the market price of all the final tires manufactured within a specific period. So in GDP calculation, market price of the final good is included, not the prices of the intermediate goods required to manufacture that final good. What are final goods and services that are calculated in GDP? So here in this picture you can see that the tires are being produced. So this is the final good. The tires are manufactured in the factory and it is brought to the shop. The tires are finished manufactured and this is the final good. So whatever the market price of these tires will be, whatever the market price of these tires will be, that market price will be included in GDP calculation. And next is, as you can see, GDP, gross domestic product. There is a domestic word. Domestic means the goods that are manufactured. The goods that are manufactured, whether the goods are manufactured being an Indian company or a foreign company, that doesn't matter. But the goods that are manufactured, it should be manufactured within the boundaries of a country. For example, these tires are manufactured. It does not matter whether these tires are manufactured by an Indian company or a foreign company, but these tires are manufactured in India. That is, it is the factory that is producing these tires, that factory is located in India. So the market price of the tires will be included. The labor cost or the capital cost incurred by the tire manufacturer is excluded. Intermediate costs are not included in GDP. Only the final market price will be included. Next, another example, the chips that are manufactured. It does not matter whether the chips are manufactured by an Indian or a foreign company, but it should be manufactured in India. Therefore, it is called domestic, gross domestic product. Next, there are many examples like the shoes that are manufactured, spectacles that are manufactured, the cell phones, or these are goods that are manufactured. Next is the services. There you can see a software engineer. It does not matter whether he is working for a Indian company or a foreign company, but where the company is located, that is important. The location of the company, it should be in India. Only then the service provided by this person will be included. Next, again, a teacher teaching in a classroom. Next is net domestic product. Here you can see that earlier we studied gross domestic product. Gross means the final market price is included. Therefore, it is gross. Domestic, that means the producer should be the factory that is manufacturing these goods. That factory should be within the borders of India, not outside India. That is domestic. And then product. Earlier we have learned GDP, now we will learn net domestic product, NDP. What is NDP? Total market value of all final goods and services produced within India's border, because it is domestic again, during a given period after accounting for depreciation of capital assets. So NDP is equals to GDP minus depreciation. It is simple. You see, GDP is gross. Now it is net. To convert gross to net, what we will have to do? We will have to subtract depreciation. Depreciation of capital asset. We will learn this. So depreciation means the loss of value of fixed assets like machines, buildings, vehicle, etc. over time due to wear and tear, uses or obsolescence. Let's look at these images. On the left, in a factory, steel pipes are being manufactured, and after cutting 10 pipes, the blade has to be replaced. So you see, after cutting 10 pipes, the sharpness of the blade gets reduced. Okay, so therefore the blade has to be replaced. So the damage cutter is the depreciation. One blade is consumed to produce 10 pipes. If the old blade used to cut the pipes didn't need replacement, then this new blade could have been used to cut another set of pipes, increasing the productivity of the factory. Instead, the new blade that the company has invested is used to just replace the existing old blade, keeping the productivity of the factory same. Now let's say the market price of the produced 10 pipes is 10,000 rupees and the cost to replace the damaged blade is 3,000. So the net output will be 10,000 minus 3,000 is equals to rupees 7,000. So in a factory, as the machines are working, sometimes the machines either get damaged due to wear and tear and it needs replacement. When it needs replacement, the company has to buy a new machine. So the new machine that the company has bought, that new machine is used only to replace the existing machines. Now if the existing machines did not need replacement, there would be two machines in the factory, and those two machines would have increased the productivity of the factory. But instead, the new machine is just replacing the old ones. Next in the picture you see this taxi, after giving service, let's say after giving service for 5,000 kilometers, needs replacing of its tires, brake pads and oil. So that is depreciation. Machines after working for a long time needs replacement. So therefore a company has to spend some money replacing its previous machinery. So that cost to replace the previous machinery, that cost will have to be subtracted from the total output given by the company. So that will be net domestic product. So NDP is equals to GDP minus depreciation. Next is gross national product or income. What is GNP or GNI? See, total market value. Since it is gross, so the final price or the final market price of the goods will be included, of all final goods and services produced by the, you see earlier it was domestic, now it is national, so produced by the residents or nationals of a country in a given period regardless of their physical location. Formula is GNP is equals to GDP plus NFIA. Okay, what is NFIA? NFIA, factor income received by the country's resident. Give importance to the word is resident. The important word is here resident from the rest of the world, minus the factor income paid to foreign resident for their contribution to the domestic production. So here the important word is that earlier we have learned gross domestic, now it is national. So it depends on the residents or nationals of a country. It is important, residents or nationals of a country. Now you see, in our country there are people who works abroad. Okay, there are people who are, although they are Indian nationals, but they are working abroad. Let's say a person is working in the US. In this example, you can see in the left hand side, a person is working in the US and for his service, he is getting money. If he sends, let's say some of the money to his home, which is in India. He sends some of his money to his home, and there is another national, that is, let's say there is an American national who is working in an Indian company. So he too is earning rupees in India, and some of the money he sends to his home, that is in the US. So in here you see this Indian man is sending some money to his home, that is, money is coming to India from outside, and here this man is sending some of his money to the US. So some money is coming into our country and some money is going out of our country. So the net factor income from abroad will be the amount that comes inside, that the amount of money that comes to our country minus the amount of money that goes out of our country. That will be the net factor income from abroad. So here you see NFI, it is the factor income received by the country's resident from the rest of the world minus the factor income paid to foreign resident for their contribution to the domestic product. So NFI, money coming from abroad to India minus money going out of India, money going out of India to abroad. The formula is gross national product is equals to GDP plus NFIA. So GDP, as we have learned, it is the total market value of all the final goods and services that is produced in India. GNP is gross national product. Here, the goods that is produced in India and also the income that comes from abroad, those two will be added. The income that comes from abroad. Next is net national product. Here you see the word, it is net. That means net means we will have to subtract depreciation. National, that means the income that is earned by the nationals of our country. So in here, as the word there, it is net. So in here we will have to subtract depreciation. Net national product means gross national product minus depreciation. Whatever the capital or whatever the value of the capital that is lost during manufacturing, those value should be subtracted. Then we will get the net national product, GNP minus depreciation. So these are the formula. As we know, GNP is equals to GDP plus NFIA. NNP is equals to GNP minus depreciation. Depreciation is also called CFC, means consumption of fixed capital. Fixed capital means the machinery that a company is using to manufacture goods. The consumption of those machinery, that will be depreciation. So net national product is GNP, gross national product minus depreciation. Remember, to come from gross to net, we have to subtract depreciation from gross. If we subtract depreciation from gross, we get net. Since GNP is equals to, as it is written, GDP plus NFI, if we replace GNP by GDP plus NFI, then we get this formula. NNP is equals to GDP plus NFI minus depreciation. Next is national income. It is very simple. National income is the NNP, net national product at factor cost. Now, what is factor cost? As you have learned earlier, that market price. What is market price? It is the price that you give when you buy something from the shopkeeper. In here, as you can see, there is written MRP rupees 55 inclusive of all taxes. That means the taxes are already included in this price. As you can see, rupees 55, the taxes, whatever it is, GST, VAT, those taxes are already included in this price. So market price, it is equals to factor cost. Factor cost means the cost that is incurred by the manufacturer to produce the good. That is the factor cost. In order to produce the good, the factory has to hire laborers. They have to give salary to those laborers. They have to hire machinery. Yes, they have to put a factory. Yes, so all of those cost. So in order to manufacture a product, that the cost that is incurred by the producer, that is the factor cost. With the factor cost, if you add taxes and minus the subsidy, you get the market price. Now, factor cost we get if we subtract or if we exclude the taxes from the market price, we will get the factor cost. So what is subsidy? One last topic is what is subsidy? So a government subsidy is a form of financial aid or support provided by the government to a specific individual business or industry. For example, if the factor cost to produce something is 150 rupees, now if the government do not pay any subsidy, then the producer will have to charge this 150 rupees directly from the customer. Now let's say the government gives a subsidy of 20 rupees. The cost to manufacture the product is 150 rupees. Government gives a subsidy of 20 rupees. Now the factor cost will be 130 rupees. As you can see here that the factor cost is decreased. So as you have seen here, if government do not give any subsidy, then the cost of manufacturing the good, that is 150 rupees, will have to be directly paid by the customer. But as the government comes or as the government intervenes, government gives a subsidy of 20 rupees to the producer. Since government gives 20 rupees, so now the factor cost will decrease. So 150 minus 20 is equals to 130 rupees. So now the factor cost has decreased, and with this factor cost, if you add taxes, let's say rupees 10, now the market price of this item will be 140 rupees. So this is subsidy. It is given by government so that the factor cost is decreased. When the factor cost is decreased, then the ultimate price of the product will also decrease. So these are the things to remember. If you want to get net, you will have to subtract depreciation from gross. If you subtract depreciation from gross, you get net. And national means domestic plus net factor income from abroad.